Good afternoon. I'm Fran Siegel, Executive Director of the U.S. Impact Investing Alliance, and welcome to our session this afternoon with Steve Liberator, who is a fixed income portfolio manager at TIAA. So we're excited to chat with you today about the growth and development, as well as the outlook on the market. So would love to kick off with you, Steve. If you can talk a little bit, and this is a question we haven't heard answered today, and we wanted to both share our paths to responsible investing. So could you share a bit about how you got into this practice, and were you always a true believer? And if not, what was your path to your current position?
Sure. Thanks for having me. One of the things, my background is in active total return fixed income management. About 15 years ago, I started managing responsible investment mandates. And as has been discussed earlier here, most ESG work historically had always been done on the equity side. So fixed income has kind of been a late arriver to the concept of responsible investing. But having worked in the space for a while, it made a lot of sense to me, and I thought that if done correctly, the utilization of ESG criteria and concepts would really be a positive and an advantage in managing, say, a core fixed income strategy. That's primarily because I have found that over time that how you generate outperformance isn't by picking winners, it's by avoiding losers. And when you apply ESG criteria, what you're really doing is identifying the best operated and managed issuers in a space, and therefore those issuers are the ones that are least likely to have a problem or blow up over time. So if you utilize that as kind of your baseline concept, and then you also add in one of the things that we do is impact investments as well in public market securities. When you add those securities in, what you have is the opportunity to add alpha through your security selection work. And we're fortunate, we have a very large team of analysts. We have 50 analysts, they average about 11 years of experience. We have 12 traders that also oddly average about 11 years of experience, and I've been doing this a little more than 20 years. So the combination of those two factors really seemed as though, to me, conceptually, that it made a lot of sense and it could truly be beneficial. And at the time, no one was doing it. So it really gave us an opportunity to really see what was possible. And thankfully, I work at an organization who has a history in responsible investing and was very keen to try to expand where possible the opportunity set. And it's really been one of the great benefits is I feel as though I've run into three main misperceptions in this space. One, you have to give up performance to be a responsible investor, and I think our performance over time shows that is not true. Two, that you can't run a responsible investing strategy as a mainstream idea, that it has to be a niche part of a portfolio, or an investor really can't be in a position to build out an entire portfolio but in a responsible manner. And I think that the way that we manage our strategies is a true core strategy. We've also just recently launched a green bond fund and a short duration impact bond fund, which we hope will allow an investor to be able to broaden out and fully construct a portfolio on the fixed income side that would be fully incorporating all responsible investing, but in different parts of the market. And then lastly, the last one is that you can't make an impact in public markets. And again, this kind of ties back to that historical view of ESG being focused on the shareholder, and you have a right to vote, therefore you can influence behavior, and that's very true. We don't have that in fixed income. But what we do have is the ability to control how proceeds are utilized from transactions. And issuers come to the fixed income market substantially more often than they will ever go to the equity market. Plus, it gives us an opportunity to work at various parts of the capital structure. We don't have to invest directly in a holding company. We can go to a subsidiary level if there's something there that's attractive to us. We have a wider range of sectors to invest in, municipals, agencies. We have the ability to create structured securities. So the opportunity set to really make an impact, which in our definition is a direct and measurable investment, really is unique, I think, to the fixed income market, and the fact that we've been able to kind of expand on that and go down that path has really been a benefit.
Great. And just to follow up, when you first learned about responsible investment, perhaps at that time it was called socially responsible investing. Were you a true believer from the get-go, or was there a kind of period where you learned more about it, and what was it that sort of turned you? There was a question in the prior session around culture and that data sometimes is not enough.
Yeah.
And so can you talk a little bit about your path?
Yeah, I think that at the time I really didn't know as much about it as I wish I did. It was something that had always interested me. And as I said, I thought that there was an opportunity that would be unique in fixed income to really do something that was impactful and be beneficial from a performance standpoint. In addition, I think what also I thought longer term was that a lot of the issues that we have in our society can really be effectively helped or corrected through economics and finance. And I think that if you are doing this correctly, you can take an investment through these types of strategies and make not only a positive economic benefit, but also a positive impact. And I think that when you see the data and you see the numbers, if we need $2 trillion to keep the world from warming 2 degrees, we know it's going to be more than $2 trillion. And there isn't $2 trillion worth of grant money available. So what we really want to be able to do is create a virtuous cycle. If we can outperform over time, then we hopefully will bring in more assets. We can therefore help lower the cost of capital to these beneficial projects or companies or issuers, and therefore create a better overall result, not only from a financial perspective, but also from a benefiting society perspective.
Mm-hmm. Great, thank you. So just a little bit, if I may, share about my path to impact investing, a bit different than yours. I started working at a family office in Los Angeles. The Peter Norton Family Foundation, who wrote Norton Utilities and Norton Antivirus, sold to Symantec. And I was a grant officer, so we were doing what I thought was very interestingly structured grants, almost like early venture philanthropy. And over time, I started wondering how the endowment was invested and whether it unconsciously was invested in alignment or across purposes to the mission of the organization. And that really led me to business school. I went to HBS, where I will say that it's perhaps an understatement to say that it was focused on the primacy of shareholder value. So this was 98 to 96 to 98. And I kind of forged my own path, wrote a paper on what I think was impact investing, but the term wouldn't have been coined for a little while. But I tried to look at how value was created in society, shareholder value, yes, but also economic, social, and environmental value, and thought that the current method of wealth accumulation by any means, potentially through that wealth accumulation, perhaps creating negative and positive social and environmental and economic impact, and then transfer through a charitable tax vehicle later in life was not the best way overall to serve society's challenges. And so moving from a paradigm of shareholder value to stakeholder value, my current role at the U.S. Impact Investing Alliance, which is being incubated by the Ford Foundation, is to really catalyze U.S. asset owners to deploy capital for impact. Our long-term vision is to place measurable social and environmental impact at the center of all investment decision making. And we are led by an advisory board chaired by Darren Walker. And just to clarify, when we say impact investing, we mean investing across asset classes globally, from depository assets to real assets. So wondering, Steve, if you can talk a little bit from your perspective about what has driven the growth of the market, and then we'll end by giving our respective market outlooks.
I think really the main driver of the market has been the individual investor or the institutional investor. I think that we as an asset management industry have not, up until now, done a fantastic job of providing vehicles for the average person to invest in that would allow them to invest in ESG strategies or in impact in a way that would allow them to understand how they themselves are making a positive benefit or a positive impact on the world. And now that we are doing that, and we are seeing more strategies that are managed along ESG criteria or with impact or both, that show good performance over time, as well as being able to report on and validate the level of impact that they're having, more investors are becoming aware of what's available to them. It's a lot of it is education. You spend a lot of time talking to individuals as well as institutions, and it's not just smaller institutions, it's even large institutions that know they should be thinking about this space but haven't really committed to doing anything yet because there is a lot of education that has to go on around it, and being able to provide information and comfort that this strategy is something that will work over cycles and over different periods of times in different markets. So it's been a very much of a growth experience where the individual investor or the institutional investor has now been able to see that there are opportunities for them to invest in a way that has a double bottom line, which I think historically just wasn't there for them.
Mm-hmm. Yeah, I agree with everything that you said. We saw some data slides earlier, specifically the US SIF numbers that look quite good, 36% increase to $12 trillion of AUM with impact. In their 2018 survey, again up 36% from 2016. I would say that the 10 trillion of the 12 trillion are in ESG strategies, and the rest are in other sorts of strategies. And so there's absolutely been growth, and I believe that there's growth at the behest of asset owners, as you say. Traditionally, I would say that foundations have led the charge. And there, I would say, Heron Foundation announced at the end of, I think, 2016 that they had deployed all of their $300 million of endowment for impact. Nathan Cummings Foundation earlier this year announced their $500 million endowment would be moved to impact over time. And where I work, the Ford Foundation made an announcement that they would carve out $1 billion of their $13 billion endowment for impact. And these are what we call deep impact strategies, financial inclusion in emerging markets and affordable housing domestically. But I would say that over time, high net worth families have really come to the fore. And I agree with Stephen that increasingly retail investors and pension funds are also getting into the mix, although I would say on the pension fund side, US pension funds are certainly lagging European pension funds. So this increasing asset owner demand has not been lost on Wall Street. Many of you work at Wall Street firms. Increasingly, we see that this has been a source of competitive advantage when they go to bid new business. And they have taken a different kinds of approach. So Goldman bought Imprint Capital. So there's been kind of buyer build strategies, depending. And I would say that asset managers, I was really stunned by a number that Peggy threw out in the opening session with VJ, that 140 ESG products have been introduced in 2018, which is pretty extraordinary. One of the things I keep my eye on is that these products are more than an asset gathering strategy, but they really see the opportunity. And I would be remiss in not noting Larry Fink's letter of January of this year, where to public company managers, where he said, quote, "To prosper over time, every company must not only deliver financial performance, but also show how it makes a positive contribution to society." Okay, so now on to the outlook. Can you speak a little bit about where you see the market going, say, in the next 1, 3, 5 years?
Sure. I think one of the areas that's most exciting to me is we're seeing this within the fixed income market is really a broader diversification of opportunity. You know, we certainly have, you know, your prototypical green bond, you know, for, say, a wind farm that, you know, produces enough power for 330,000 homes, displaces 1.7 million tons of carbon dioxide equivalent annually, which is equal to taking about 330,000 cars off the road. But we're seeing new things come to market like blue bonds, where you're able to take the concept of green financing and apply it to investments for countries or areas of the world that are much more tied in their overall economy to the oceans. And you know, these are new types of strategies and concepts of investing, which I think show the opportunity continues to broaden and diversify. I think the area, though, that is most exciting to me and what I think will impact the most people overall, not just investors, but individuals, is really if we are able to continue to build out the securitization market for distributed generation. If we are able to, when you think about why most people own cars and homes and are able to get student loans, it's primarily because you've been able to have a very functioning, deep and broad capital market process for the asset-backed security business. That has made the ability of people to finance those various purchases much more attractive and much more viable. I think that as we continue to invest and ramp up the concept of solar loan and lease securitization, for example, if we are able to continue to get that going at a more rapid pace so that it becomes a typical asset class that is financed through asset-backed securities. That is going to help lower, again, the cost of capital for a solar array, but it's going to start bringing down the weighted average FICOs in the transactions that we look at, for example, where it's not going to be 750 anymore. It may get down into the 600s. And if you can do that, then what you have really done is made the concept of distributed generation much more viable for the average person, which is what we really need to be trying to get to if we really want to make a dent in our draw on the grid and transitioning over to renewable power.
Great, thank you. I'll kind of pop up. That was so specific and really valuable to hear your thoughts. And you know I'm a little obsessed with fixed income, so maybe we can take that offline. I think that there's you know that I've been very interested in following the rise of, or the paucity of ESG target funds, and I believe that those have been slow to come to market for the 401k market, in part because of fixed income. So I'd love to take that offline with you. A couple of thoughts. Vijay talked about millennials, and we know that from different studies that 2/3, 3/4, or even 90% of millennials are interested in investing with accordance to their values. We know that there's a transgenerational wealth transfer afoot, $30 to $40 trillion over the next 30 years. That money will first go to women. 80% will go to women, and then they will transfer to millennials. And so this is really important. It has implications for the asset management side, but also the wealth advisor side and serving those clients. So we believe that that's a sea change. A couple things that I have my eye on as challenges. One is this persistent cognitive biases, like this trenchant belief that there's a trade-off, needs to be addressed. And we talked a little bit earlier on another panel about cultural change as well as data. The second is the state of the art of impact metrics measurement and reporting. I believe that will get us only so far. I believe that we need verification audit, and audit in the same way that we have verification and audit on the financial side. And finally, just a shout out to the market infrastructure that is needed, whether it's policy, metrics measurement and reporting, product development, other things that have traditionally been grant supported. Sadia from Rockefeller was on the stage a moment ago, and she and those at Rockefeller coined the term impact investing. They put tens of millions of dollars into catalyzing the field. The public goods that allow you to move capital from point A to point B are based on these public goods, or the kind of infrastructure or plumbing that allows money to flow. That is all grant supported by a handful of foundations. I can count them on the foundations on 5 hands. Five hands. That would be really interesting. I'm hiding them behind my back. 5 fingers. And so it's just a shout out to the need for infrastructure building. So I think we only have a couple minutes for questions. So please.
Yes, let's do a couple quickly. It makes sense that analyzing governance factors could help you avoid negative credit events. Can you give us examples of how you've used environmental and social factors to avoid losers?
Sure, and thank you for not falling asleep while I was talking about fixed income. I appreciate it. Environmental one is a little bit more straightforward and easy to think about. When you think about it as an investor, and it really doesn't matter what part of the capital structure you're in, do you want to invest in an issuer who has material financial exposure to the environment, but they're a poor steward of the environment? What they have done is put at risk their ability to generate free cash flow. And that free cash flow is obviously, as a creditor, the most important factor to us in being able to repay our loan to them. What a good example of that would be BP. As an investment grade fixed income investor generally, the ability for me to have identified BP as having a poor historical track record in regards to the environment, and I think the new CEO is attempting to shift that, you were able to see the potential risk that they put themselves at because they were poor performers along the concepts of environmental strategy. As an investment grade manager, what it allows me to do is avoid an issuer who 1 minute after the Macondo well explodes, their 10-year bonds are down 10 points, duration adjusted. As an IG investment manager, it's very hard for me to make up those 10 points somewhere else in the portfolio. So it really serves as a good way to measure risk within the portfolio, is identifying those issuers that may have some potential problems or liabilities just based on their own actions and in their own processes.
If we relax the rule that fiduciary obligations are entirely related to monetary return and can also include social and environmental returns, how do you think markets would change and how big would that impact be?
I'm happy to talk policy because we do a fair amount of policy. So in 2016, the Treasury Department issued guidance for foundation fiduciaries around impact investing and ESG. And at the same time, the Department of Labor issued 2 interpretive bulletins allowing ERISA-regulated pension fund fiduciaries to take impact factors into account when making investment decisions. So it's not the obligation, but it's the option. And I believe that over time, as we show materiality through SASB and other mechanisms, we talked a lot already about risk reduction and risk mitigation and returns over time by taking these factors into account. We believe that pension fund fiduciaries, foundations, and other fiduciaries will increase the practice.
And I don't think that you don't have to give up one for the other. You know, I think that when you look at various strategies, and I'll just use mine for a second, I manage against the Barclays aggregate index, so against all fixed income, regular, non-green, non-ESG strategies. Over a 5-year period of time, I'm in the 4th percentile of performance because we have a great team and have generated great performance. You don't have to give up both. You don't have to give up one to do the other. I think the key is going forward is, as an asset management industry, are we able to generate strategies that do provide both a positive financial return as well as a positive impact?
Let's get 2 quick answers against a break. Are you seeing demand for ESG or impact labeled strategies, or are clients asking for regular asset class categories with this embedded? Does it need to be labeled?
Does it need to be labeled? Well, I speak to a lot of fund managers, and some of them, they're all impact managers, and sometimes when they pitch, depending on the client, impact goes to the foreground or the background. My feeling is that over time, and I think Vijay said it best in the opening session, is that all investing has an impact. And it is hidden from us. It's largely opaque. And I believe over time that negative and positive externalities will be priced into the market, and it will just become all ESG will be embedded into the market. I want to drive impact alpha out of the market, normalize it.
Last one, really quick. For looking at sources of data for SRI and ESG, what should investors be looking at?
I think
Where should they get this?
Yeah, I think that there is really a wide array. It really is no different than any other form of data that you look at in making an investment decision. You should look for the widest array of data. You should be pushing for the appropriate amount and consistently focused on transparency and disclosure. That's something that we work a lot with. When we work with issuers, you know, we view our engagement in how we structure the investments we work with on them, but we're always pushing for transparency and disclosure. We try to push for as many third-party sources of data as possible, but we do recognize that all is going to start with the issuer themselves providing and being comfortable with providing data to not only investors but third-party, and we see that much more in Europe, but here we're starting to see a little bit more comfort with providing that level of data as well. But always be looking for a wide array of data. Don't take one view because that's not going to be the appropriate view, and make sure you look at data providers that have a history in the space as well.
Thank you.
Thank you.